Welcome back to Market on Close. It's time for Options Corner. Kevin Green is here to discuss some levels. So, Kevin, I'm taking a look at the S&P 500 right now, decidedly lower. Every sector back in the red aside from comm services, although not, at least not at the lowest levels of the day. We've been all over the place. So what levels are you looking at for the S&P 500 going into the close?
Yeah, I mean, if we close here being down 0.6%, feels like we're flat on the session, to say the least here. I think the market's really trying to decide what the president's really going to say. He is actually making some remarks right now, so you're seeing a little bit of a holding pattern when it comes to the price action here. But if I'm kind of looking at going into the close, you have some pen risk at 5,000, at that 5,000 level. There's a significant amount of options positioning there just across all of the major expirations, a lot of the quarterlies, as well as even the April expiration that's going to expire next week. And so we might have a little bit of pen risk there. If we do get some positive energy to the market, so we try to bounce to the upside, I'm looking at 5150 to around 5200. We highlighted 5200 earlier this morning. We broke through it briefly and then faded back. But that could be an area to the upside here. And then to the downside, 4950. You know, Caroline, the one thing that I would just put out there as far as risk, I mean, we had this announcement from President Trump, and he just confirmed it in this press conference right now regarding increasing those China tariffs by 50% if these retaliatory tariffs from China are not removed by tomorrow. And it doesn't appear that the market is really taking that threat too seriously. So that is actually a really big potential downside risk, not only to the equities, but also potentially a re-rating when it comes to yields here. So let's see how the market actually positions going into the close. We've been trying to push higher. Mega cap tech has been kind of leading the way anytime that we had this push to the upside here. But I would just put it on the radar for a lot of individuals. Next 24 to 48 hours, we actually have probably even bigger risk than the first China announcement that we had. If they do come back and retaliate again, the market is not pricing that in whatsoever.
All right, so I want to talk to you about what that could mean in terms of volatility and the VIX. I do want to just say I'm taking a look at the Reuters headlines from what President Trump is saying. And as you said, he did talk about China. He says, we will talk to China. I have a great relationship with Xi. Hope it stays that way. In terms of that 90-day pause, which they called fake news, according to CNBC, he did say we are not looking at a 90-day pause. And he also says tariffs could be permanent and could also be talks. So basically not learning a whole lot from here. So if it could be riskier over the next 2 days or so, what are we seeing in terms of volatility in the market, and what could we see?
Well, volatility, if you're looking at the VIX, is still elevated. We're still sitting at around a 47, about a 48 VIX. That's implying around a 3% intraday move to the upside or downside. And you're seeing that reflected also in the S&P options, not only on the wings, which is really what the VIX is being priced off of, but also when you're looking at the money calls and puts. And unfortunately, that is actually driving options volume on the index level. If you're looking at the NDX, if you're looking at the Russell or the S&P 500, to drop dramatically. Last time that I checked before coming on here, the top traded contract today is only sitting at around 39,000 contracts being traded. That's the 5,200 calls. Caroline, at this point in time, usually we're sitting at around 78,000, maybe even close to 100,000 contracts being traded. So you're seeing about half of that volume, even maybe 60%, 30% of the average volume that we usually see. So it will compress trading activity on the index level, but even though the individual equities, we're probably still seeing a lot of options flow that is there. But VIX is at a very extreme range. We're talking about a 6 to 7 standard deviation move to the upside. It can stay elevated for some time. Back in 2008, the VIX was elevated for almost a month and a half or so before actually moving back to the downside. But if you're a bull, you want to actually start seeing us incrementally moving lower here when it comes to the VIX, and hopefully that's going to provide equities a little bit more of a boost to the upside here. But if China does respond and they respond in a negative way, we could actually see a pretty significant blowout of the VIX to the upside. And I'm talking 60 level, 70 level type of blowout.
All right, we'll keep our eyes on that. Just should note that NASDAQ has turned positive. S&P 500 basically back at the flat line right now. Dow's still down about, call it 320 points right now. So anything else catching your eye as we head into the close?
Yeah, I would look at the yield market. 10-year treasuries had a massive range today. If you're looking at the micro futures, we were trading down to around 3.82% to the high of around 4.21%. That's a very wide range when you're looking at the yield market in general. But you did see a backing off. Now we need to see maybe a little bit more follow through over the next couple of sessions. Is this a backing off because risk is starting to be are we starting to see more of a risk on tone? Are we selling out of treasuries, getting into equities? Or are we also kind of selling out of treasuries in preparation for some major auctions that we're going to have this week, the 10-year and 30-year auctions? And a lot of these foreign buyers, the ones that we're kind of having a trade dispute with, are major buyers when it comes to the treasury market. So that one's one to keep your eye out on. Intraday volatility, very, very high. This is probably one of the bigger moves that I've seen on a 24-hour basis for yields since I've been looking at markets, which has been over around 20 years now at this point. So keep your eye out on that. That could be your risk on. That could be a risk on type of indicator, or it could also indicate that maybe people don't want to get ahead of these auctions if they do become a little bit weak, or if they come in a little bit weak because of the lack of foreign demand.
It doesn't really play into the recession narrative, though, or the whole Fed's going to cut 5 times this year narrative.
If yields go up?
Yeah, a 10-year yield ticking higher.
Yeah, well, I mean, it was an aggressive move to the downside. You're looking at around a 50% retracement from what we saw pretty much at the beginning of the month to the lows that we saw earlier this morning. So I would say that we're at a 50% retracement level. You don't want to see the 10-year go too much to the downside while Fed fund futures are still sitting at around 4.25%, 4.5%, what have you, that range, because structurally it will actually create a liquidity drain in the debt markets. And that's one of the key areas that has not broken yet. We're seeing some fractures, but it hasn't broken yet. So you'd like to see actually some stability in yields and maybe maintaining around this 4%, 4.2% instead of seeing a yield at 3.8 or 3.6%.
Okay.
That disconnect will be a major issue for credit markets over the next two to 3 weeks, actually.
Okay. All right. Always appreciate your insights. Kevin Green, thanks so much.